So let's go.
So the FM will finish around 12.
FM. And by 3 hours we should be done.
So this one, 2 3 hours, you should be done.
No, this one depends on what we do today. So depending on what we do today, we will try and see if we can cover as much as we can. So let's go. Question 1. On 1st October 2015, Plato acquired the following non-current investments: 3 million equity shares in Savannah by a share exchange of 1 share in Plato or whatever for every 2 shares in Savannah plus $1 per acquired Savannah shares in what? Cash. The market price of each Plato share at the date of acquisition was how much? $6. 30% of equity shares of Excel at a cost of $7.5 per share. Now listen carefully. Only the cash consideration of the above investment has been what? Recorded. Remember when we were doing that? Okay, so group structure first. Parent company, Plati, sorry.
What do you get between?
Plati and then Savannah. Yeah, there's questions now. And then the associate is Excel. Okay, so Plati, Excel. Now, here we are not given the percentage of acquisition, right? So we have to calculate it. Then, so Excel is here. Then we have NCI there. So let's see. We acquired them on 1st of 2015. What is the year ended for the company? 30th September. So it's a full year acquisition, I guess. And 1 year. How many shares did we acquire? How many shares did we acquire? We acquired 3,000 shares, isn't it? No, we acquired how many shares of them? 3,000. And there were 3 million. Another one. So 3,000 divided by the total shares they are having is what? 4,000 times 100%. What do we have? 75. So we are, our control is 75%. So NCI will be what? 25%. Makes sense. Then Excel, we are told we acquired 30%. So that will be accounted for as per IAS what? 28. Investment in associates. Okay. So having had that, let's see what's happening. The fair value of consideration transferred. What are we going to have? We're going to have the cash, which is how much? We are told they paid $1, isn't it? For cash. So $1 times 3,000, and that will be 3,000. Then the share exchange. What did they say about the share exchange? What did they say about the share exchange?
Share exchange of 1 share for every 2 shares in Savannah.
So 3,000 times 1/2 times, what is the market value per share?
And the date of acquisition was
$6. So what do we have? 9,000. So fair value of consideration transferred will be how much? 12,000. Okay. Now be careful here. We are told that this thing is not recorded. Only the cash has been recorded, right? So the share exchange hasn't been recorded. So this transaction has to be split into 2. We need to get a stated capital aspect, and we need to also get what? The share premium, right? So the stated capital we will get how much? It's $1. The nominal value for the shares is $1 each. Can you see that in the balance sheet? So that is what we go to the stated capital. So that's going to be $1 times 3,000 times 1/2, and that will give us 1,005. Hence the difference will go to the share premium, and that will be how much? 7,500. Does it make sense? That is $5 times 3,000 times 1/2. Are you following? So when we go to the balance sheet, This 1,005 will be added to the parent equity shares of 10,000 to make it 11,500, and then we are going to be bringing what? A share premium of 7,500. Okay. All right. So that is a split. That's a split about this.
Are you supposed to show workings for that?
Workings for what?
Split.
If you don't show workings, how will you do it in the statement of financial position? So you have to.
Because I not recorded, that's why.
Yes. You know, I emphasized on this thing when we were doing our revision, that if they have not recorded it, we have to record it and split it into two. Now, then, I'm not even numbering. Then the investment in associates. Now remember, I have not read a question yet too. It's still the preambles that we are using, isn't it? So investment in associates, how many, cost of the investment, how much did we pay? We acquired 30% of, what is their total shares? What is their total shares? So 30% of 4,000 times 7.5. What do we have? 9,000. Now you know we are using the equity method, isn't it? So quickly we have to calculate share of what? Profit. Now what is the profit for the year for ACCA? 5,000. So we take 30% of that 5,000. What do we have? 1,500. So the total figure to be taken to the balance sheet in relation to investment and associate will be 10,500. Remember, this figure will go where? Group retained earnings. Sounds good? So that is the workings for that as well. So still in the preamble, these are the following workings that we can do. So summarize draft balance sheet of the three companies at 30th September 2016 are follows. So we have the plan, we have the plantee, we have the Savannah, we have the ACCA, and we have the information there. Let's go to the flip side notes quickly and deal with the notes. Note 1. At the date of acquisition, the fair value of Savannah's assets were equal to their carrying amount with the exception of Ebazi. Savannah's land, which had a fair value 500 Ebazi below. So you should have subtracted, but I think you were adding. At the date of acquisition. No, you should be added. You should be subtracted at the year start, because, but you took it to the year end rather. But listen to it carefully. Below its carrying value. But or see, it was written down by this amount shortly afterwards the acquisition and has not changed in value since then. Now, if it was written down after the acquisition, meaning that same figure is not at the year end. So, if I come to the net assets of the subsidiary, so net assets of Savannah at acquisition at year end. So stated capital, what do we have? The same thing. Retained earnings. 6,500. The same thing will go here, isn't it? Then fair value adjustment. TNA 500 below. What's your problem?
2,400.
Which 2,400?
I'll be below the retained earnings for year end.
We will come there. So fair value adjustment at year start, so we subtract it. But from the question we are told that it was written down by this amount, meaning that figure is not at year end again. So in this case, year end will be dash. This is the difference between the various questions we've solved. In the yes, we are supposed to bring it here. But Ankasa statement in here, it was written down by this amount shortly after the acquisition. If that statement wasn't there, and the same figure will be here, then we will calculate the depreciation as we know how we are supposed to do it. But in this case, because of that statement, it means it is no more there, so that year end value will be dashed.
The same value also.
When, assuming that statement was not there, then we will bring the same value. Then now you are calculating depreciation on that. Then they are by year end. Are you getting the idea?
Are you going to subtract it at year end?
And say a negative, sir, because it is below. Right? Then you now do the depreciation at year free. Then profit for the year. So this is where your figure that you spoke about come in, 2,400. Does it make sense? So that counts at the year end. Because profit for the year always counts. And this is also a full year acquisition. I've cleaned my board. Which means that we are not going to what? Prorate the 2,400. Now, we don't know if there is any other information. So for now, let's hang it here. But that is note 1. We've dealt with note 1. Note 2. On October 2015, Platy sold an item of plant to Savannah at its agreed fair value of 2.5 million. Its carrying amount prior to the sale was 2 million. The estimated remaining life of the plant at the date of sale was 5 years. Straight line depreciation is used by the company. Yes, what do we see here? What do we see here? Companies are not supposed to trade, okay, among themselves. Who is selling to who? Who is selling to who? Platy to what? Savannah, right? So the parent is selling to SAP. Now, if you check it here, they sold the asset at what? 2.5. But the carrying amount of the asset was actually what? 2 million. So provision for unrealized profit is going to be 2,500 minus 2,000, and that's going to be what? $500. Make sense? But this is provision for unrealized profit about the plant. Because intergroup trading, when there is intragroup trading, you can't make profit for transferring an asset to me. Hence, since the asset is still being used by you, they have to carry it at 2,000 and not at what? 2,500. Now, what does that mean? It means that we need to, now we are told depreciation is calculated on this amount. Hence, the depreciation of that should be what? 500 divided by 5, and that will be what? 100. Into how much value is left? So amount to statement of financial position will be the 500 minus what? 100, and that will be 400. So this 400, listen carefully, is provision for realized profit. You don't for TFE, property, plant, and equipment in the balance sheet. Okay? Because they are carrying the assets over the value that it is supposed to be carried at.
So if you're supposed to be inventory.
Inventory is inside. This question has inventory inside.
I'm talking about if, like, what is sold.
Yeah, like inventory is also inside. But then, yes, inventory is also in this question. So if it was inventory they sold, then the provision for realized profit and can record the inventory. But inventory is in this question. I think that's the note 3. Are you getting it? Oh, jumpy. How we get a white case here? Very important. So now this 400 will go and will be deducted from the property, plant, and equipment in the statement of financial position. Why are we doing that? Because the asset has been sold off at a profit. At a profit. Next one. Note 3. During the year ended 30th September 2016, Savannah sold goods to Platy for 2,700. Savannah had marked up these goods by 50% on cost. Planty had a third of the goods still in its inventory at 30th September 2016. There were no intragroup payable or what? Receivables. Meaning there was no current account outstanding between them. So we go. Provision for unrealized profit, and this is about what? The inventory. So what is that? 50% on cost, right? But we have the selling price, so it will be 50 over 150 times 2,700. What do we have? $900. Now, but we are not told that the whole 900 is available. We are told that what? Planty had a third. So actually, the provision for unrealized profits to be taken to the statement of financial position is actually going to be 1/3 of this figure, which is what? 300. So this $300 will come here because the subsidiary sold. So provision for unrealized profits. Okay, it comes here. Okay, it's 5. Then when we go to the statement of financial position, this 300 will be deducted from the inventory. I hope we are following the principles. Right. Note 4. In payment terms of September 30th September 2016 concluded that the value of the investment in Excel was not impaired, but goodwill was impaired by how much? 900,000. Now, if goodwill is impaired, that 900,000 we will subtract it from the goodwill. Then we will subtract that same 900,000 from where? Group retained earnings. Sounds good? We will come to group retained earnings in a moment. 5. The available for sale investments are included in Planty's balance sheet above at their fair value on 1st October 2016. But they have a fair value of 9 million as of 30th September. So what has happened? If you check, the value here is 6,500. Can you see that? But now it has increased to 9,000. So that is a gain on what? Available for sale investment. Okay? So we'll bring that or take that to the group retained earnings. Have you seen that? It was carried at 6,500, but now the value has increased to 9 million, which is 9,000. Hence, the difference. What will be the difference? $2,500. So gain on available for sale investment. That's 9,000 minus 6,500, and that is 2,500. Now this will go to group retained earnings. That's it. Now give me total answer for acquisition at year end for the net assets. Give me total answer here quickly.
So it means that you're not supposed to close the net assets.
Yeah, because I'm thinking that maybe the subsidiary is the one selling, and now there will be other transactions.
Go through all the footnotes before you can.
Yeah, you can leave it open, like the way I've done. Leave it open because it won't harm you. I get the idea. It won't harm you. Then this one is how much?
So what's this?
So what do? We use the 10,000 in the calculation of what? Goodwill. Then let's find the difference. That will be post-acquisition profit, right? 2,600. And we will use that in the calculation of non-controlling interest as well as what? Group retained earnings. Make sense? So that's it. That's it. So I don't know how you arrive at 2,400 for the post-acquisition profit. Yeah. And then, strangely also, Rosa also arrived at their same answer. So I don't know what you guys were doing. You were not also together. If not, I would have said. Right, so, in this question, we realize that nothing has been said about non-controlling interest. Nothing about the value of non-controlling interest at the date of acquisition. So, in cases where nothing is said about the non-controlling interest of the value of non-controlling interest at the date of acquisition, that means we can't have any value for them. Meaning the goodwill to be calculated will be just based on our ownership in the company. So how is that going to be? So goodwill. So what was fair value of consideration transferred? So we paid 12,000. Now look at what we're going to do. Less net assets. Now, since we did the revaluation, listen carefully, we did the revaluation, we saw that how much was the value for, okay, their equity shares are how much? 4,000, right? And then their retained earnings was 6,500. But then, you remember that, so how much did we get for total? How much did we get for total? For the net asset acquisition, 10,500. But you see, 10,000. So this is what we're going to do. We're going to just bring the share capital of them 4,000. But TNA, say you're going to retain earnings now. Yeah, to be funding the number because we don't have NCI value. So for the retained earnings, we will take our 75% of how much retained earnings they are having, which is the 6,000. Why are we taking 6,000? Because their net asset was 500 watts below. Into this question is breaking a lot of rules in relation to what we know already. So 75% of 6,000, what do we have? 4,500. Sorry. So we add that up, and that gives us 8,500. So when we subtract that, we will get a goodwill figure of how much? 3,500. Right. No. What is the equity share we acquire? Who is that? Good evening. Now, look at it. We made an error here. Once retained earnings, we are taking 75% of the earnings, isn't it? So the share capital, we need to look at how much share capital we own in the company, which is how much? 3,000. And now, we are taking everything 75% because the value of the NCI was not there. Are you getting it? So we are just taking 75% of our ownership. So that will be 7,500. In TNT Freeman, the goodwill figure will be what? 4,500. But we are told that there is an impairment on goodwill of how much? How much was the impairment? 900. In TNT Freeman, the amount to be taken to the statement of financial position will be how much? 3,600. Now, so this is what I want you to know. This question is breaching everything you know about calculating goodwill. Why? Because we don't have the value of NCI at what? Acquisition. So what I'm telling you is that if the examiner doesn't say anything about NCI at acquisition, then calculate the goodwill based on the parent's ownership. So when it comes to the net assets, you're just going to be taking what? 75% of the net assets. So our shares that we bought, retained earnings, we will take only 75%, and then that will be used to calculate what? The goodwill. So that is what you must understand when it comes to dealing with goodwill when the non-controlling interest value is not given at acquisition. So this is what goes to the statement of financial position in relation to goodwill. Building up on that, we come to group retained earnings. What do we have? What do we have? What will be their profit? The parents retained earnings. Add the two. What will we get? 24,000. And then what else? There is an impairment here. Okay? So it will come. How much? 900. Then there was something that available for sale. Who's available for sale was it? Parent. So gain on available for sale. That was workings what?
6.
How much?
2,500.
Gain. So we add. What else? Provision for unrealized profits on the what? Disposal of plant. And now, say workings visa. The disposal of the plant. Workings what? Remember I told you that 400, we will deduct it here. What else do we bring? Share of profit. How much profit did the company make? $2,000. You sure? Post acquisition profit is not 2,600. So give me 75% of that. How much? 1950. What else? Share of profit from the associate. How much was it? How much? Some more figures needed that.
So it's 5,000, 30% of 5,000.
Huh?
Yes, then 500.
What's it?
It's 1,500.
1,000. Now say I yes our work is needed that from the investment in associate. Or is it not already the investment in associate?
No, I was saying 30% from the 5,000.
Yes. Yes. Supposed to be 30% on 5,000. Okay, so are we done? I guess so. So let's add up. What will we have? Okay, so that's the group retained earnings. Then we come to NCI. We will still have to calculate NCI. Okay? We still have to calculate. Now, NCI has no value at acquisition, so the only thing that will come here is their share of what? Profit. Which is going to be still 2,600 by 25%. What do we have? 650. All right. So that's it. Now, one thing that you have to understand is that right now, the NCI value we calculated here is based on this profit that they made, right? But sometimes we need to ask ourselves, okay, what value can we place on the NCI at the end of the day? So to find out a value that we can place on the NCI, what we will do is to ask ourselves, what is the net asset at year end? So what was the net asset of the subsidiary at the year end? From the net asset account we prepared. 12,000 what? 600. So we could say that let the NCI value, in like the value in total, should be what? 12,600 times say by 25%. Is that not what they owe? They own. How much will it be? That's 31. So listen carefully. So this share of profit is not going to be what will appear in a statement of financial position, but this is what will appear in the statement of what? Financial position as the value for the NCI. Are you getting it? So this is what you have to understand. When the NCI value is not given and you are valuing the NCI at year end, we don't need to calculate what? This share of profit. All we will do is to go to the net asset at year end, and whatever figure is there total, we pick the percentage of the NCI. So this is now the figure that will go to the statement of financial position as the value for what? NCI. So that's very important. That's very important. So this question breeds everything we know about consolidation and makes our life really nice. Really nice. This thing is difficult. I don't see anything. Oh, you're lying. Over there. Okay, so let's prepare the statement of financial position. Can I king? Everybody that. What your baby? How's it there?
Hey, sure, you want to know
why late? I mean, I agree. Obi na so was late.
Now we get your money.
Because
It takes a second holiday.
I tell you what it is. I saw a meeting there. I saw it. Okay, so let's go. Platy Limited or Platy Group. I'm writing this shortcut, but write it in full. Statement of financial position as at. Go and do that in the example. Group statement of financial position as at. What was the year ended, please? 30th Sep 2016. Okay. So we go. What are we going to bring? Assets, right? What are the assets we bring? Property, plant, and equipment. Let's go. Let's go. 18, Come on. What else? Minus. What did I ask to be minus? The 400. It was provision for unrealized profit on disposal of assets. That is in note 1. Sorry, note 2. That the parent sold an asset to the subsidiary and they made a profit on the disposal of the asset. And you can't sell an asset and make a profit. So they made a profit of 500. However, 1 year has passed by and the remaining life was 5. So yes, sir. So they made a profit of 500, right? But it was left with 5 years. But 1 year, so we write off 1 year. Now I bet you 400 name for that. Now, remember what I said also, that even though there was fair value below 500, we are not bringing it here because we are told it was written down, and that's from note 1. Until you see let's say 400. Next item.
The only thing I would have added the subsidiaries with.
Oh yeah, there. And I'm exactly. Also because of the 100. Until I come here today, come here to 400. Yeah. Yeah, you were saying something.
All the trades now, and I'll add all of them.
Why? Excel is an associate. You can't consolidate associate financial statement.
It's confusing.
It is not.
No, it was confusing because me from it, sometimes I take the figure and later I realize that, hey, I need someone again.
In the Excel, what we did now.
So like, for instance, say, oh yeah, we income statement. Still, you are not supposed to.
It's an associate. You won't bring his results. The only thing you bring is share of profit. And open a paper or income statement. After gross profit, then profit from associates will come. Under the parent, you take it to the total. Are you getting it? Investment in associates. Yeah, what can see in what's it? 10,500. Working is what? Eh? Oh no, oh my any working so. That like well crime if you want some available for sale. The new figure, right? Which is how much? 9,000, I guess. Is it 9,000? In the footnote. Is it 900 or 9,000?
I think got the thousands and so.
It's 9 million here, so you are bringing 1,000.
Then the footnote is 900,000.
900,000, man. Are you reading well?
Okay.
Now you. Now I'm goodwill. Working is what? Seven. How much? Now working 7 and bomb me.
600.
Hey, Charlie. I don't share you. Goodwill no go share you. Oh, Munya came add all for me. Then we go to current assets.
So they are writing.
Stop writing.
Don't go and be out there.
But if they are right,
Okay. I've closed. Keep on writing. 51,500. Current assets. What do we bring? Inventory. Let's go.
6,900.
6,900.
6,200.
6,200. Then there was provision for realized profit of how much? 300. So you mean trade receivables. Trade receivables. Let's go.
3,200.
You remember we were told that there was no trade receivable or payable between them. 12,800 and then
4,700.
Mama go board no so be on phone.
So you want to go home?
7% more than 1% me phone. Okay, there was no cash, so please add the 2 for me. Add it up. Let's get total assets.
69,000.
That is what you want.
Yes. It's flowing like that. Let's go. Equity and liability. What we got? Equity first. Let's bring share capital. 10,000, right? Remember, the share exchange hasn't been recorded. So we need to record it. How much was the share capital amount of that? We did the workings. 1,500, nigga. That will be 11,500. Since I'm be bomb yem. Me shena mo kasana be bomb yem. I'll start with the glass papers. Share premium. What do we have?
7,500.
Workings, everything. Workings one. I hope you are following the idea. So those things we did there, the effect will be incorporated here. Then group retained earnings, workings. How much?
28,650.
NCI value, right? Workings.
10.
3-1.
50.
Here we are now.
Equal.
Okay, so let's add the equity up to get the total equity. $50,800. There we go. What else? Liabilities. What do we have? Yes, sir. Liabilities. Non-current liabilities. What do we have? 7% loan notes. How much? 5,000 plus, and that gives us 6,000. What else? Current liabilities. How much?
4,200.
Making, is that all?
Yes.
Add it up.
18,200.
Add it to the equity. 69,000. Yeah. So there you go. So our balance sheet has balance. That's what the examiner said. You don't understand what?